Hi everyone. I can see there's a few people on the call, but I'm going to leave it another couple of minutes just so additional people can join. Okay, I'll make a start. I'm sure there'll be another few people joining over the next couple of minutes, but as we've only got an hour, I think it makes sense to kick off. So hi to everyone who's on the call. Thanks for joining. This is the second in our series of 3 webinars on cryptocurrencies. My name's Jenny Warren and I'm a partner in the derivatives team here at Fieldfisher. And I'm joined on the panel today by my fellow derivatives partner, Edward Miller, Dougal Molson, who's a partner in our structured finance team, and Stephen Burrows, who's a director covering financial markets regulation. Next slide, please. So just looking at what we're going to cover, and apologies to anyone who's specifically interested in repo. We had advertised that we would be covering repo today, but when we thought about it, we felt that repo was actually maybe better suited to next week's session on crypto lending. So we've taken repo out of today and we'll cover that next week instead. So what we'll look at today is an overview of the crypto derivatives market, look at some of the recent developments. Then Edward's going to take a deeper dive into the digital asset definitions. Dougal will look at structured notes, and then Steve will look at the Prudential treatment for crypto asset exposures, which is quite an important topic for financial institutions looking at entering this market. Just to say before we start, there is a questions box in the webinar, so if people do have questions as we go, just feel free to type them in. And I think rather than interrupt the speakers, we will just keep questions until the end. Okay, next slide, please, Jess. And next slide again, please. Okay, so I thought it would be useful to start just by looking at the crypto spot market, and I guess by stating the obvious that it's a story of exponential growth. This is a graph that I pulled off CoinMarketCap yesterday and shows the market capitalization of the cryptocurrency spot market, represented by the blue line, and trading volume represented by the darker line below. And you can see that in terms of market capitalization, it's gone from essentially non-existent 5 years ago to reaching a peak of close to $3 trillion in 2021. Then there's been a bit of a decline over the last year to 18 months, primarily driven by the various bankruptcies and liquidity issues in the cryptocurrency market that we're seeing at the back end of last year. So as of yesterday, the size of the market was just over $1.1 trillion. Also, just to highlight a few other statistics which I think are interesting. So as of yesterday, CoinMarketCap reported that there were 23,000 cryptocurrencies available. Now, obviously, the lion's share of the market is Bitcoin, which represents 46.3%, followed by Ether, which represents 18.6%. So that leaves 36% of the market for the remaining 22,998 cryptocurrencies in existence. And then also just to mention that there are currently over 500 crypto exchanges out there. The majority of those are in the unregulated space, so probably not of huge interest to most of you on the call. Okay, next slide, please, Jess. So now looking at the crypto-linked derivatives market, by contrast, this is valued at approximately $3 trillion, so 3 times the size of the spot market. And derivatives contracts are thought to make up around 2/3 of the total crypto trading volume. And in fact, data suggests that the crypto-linked derivatives market has regularly exceeded the spot market since about 2021. In terms of the derivatives products that are available, this is primarily, most of the liquidity has been in the exchange traded space. In 2019, CME launched Bitcoin and Ether futures and options. There are other exchanges, for example, Deribit, which offers Bitcoin and Ether exchange traded options. Eurex also launched an exchange traded note future on Bitcoin, and that future offers physical settlement of the exchange traded note, which is then redeemable in Bitcoin. On the OTC side, most of the transactions tend to be, again, referencing Bitcoin and Ether, which is reflective of the liquidity in the spot market in those two currencies, and that those tend to be forwards and options. And importantly, both on the exchange traded and OTC products, these all tend to be cash settled for reasons we'll come on to in the next couple of slides. Okay, Jess, next slide. So in terms of how we explain how the crypto derivatives market has grown so exponentially, there are a couple of reasons. I think the obvious explanation is that it's a normal response to the growth in the spot market. It sort of generally follows that when a new primary market develops, the secondary market tends to follow as market participants look for opportunities to hedge their physical exposures, leverage their positions, as well as looking for liquidity and price discovery. So that's probably a natural, just a natural evolution. But that doesn't necessarily tell the full story. And when we've spoken to clients, anecdotal evidence seems to be that while there is a little bit of, I guess, skepticism or risk involved, or I guess some sort of doubt about the crypto markets, there is also a slight fear of missing out, because obviously people have made quite a lot of profit in cryptocurrency trading and people want to get a slice of the pie. It's no surprise that as the price of Bitcoin rises, the trading volumes seem to go up, and as the price of Bitcoin falls, it goes down. So there's a little bit of not wanting to fall behind competitors and peers by not being involved when other people are. In recent years, there's also been more interest from more sophisticated investors like hedge funds and asset managers looking to get involved in the asset class, and they would be obviously more familiar with derivatives and their advantages, which has created more liquidity in the derivative space. But potentially the more interesting reason is the fact that crypto linked derivatives can be cash settled is advantageous because there are certain hurdles and challenges involved with taking physical delivery of or physically holding cryptocurrencies. So looking at what some of those are, the primary one is that there's still quite a lot of legal certainty about how you can hold or own cryptocurrencies, what your property rights are, how you can enforce your rights, whether you can take security, how you can enforce security over cryptocurrencies. And that obviously has quite big implications if things go wrong. So looking at some in terms of some of the ways that you can hold cryptocurrencies, you can, if you hold them on chain, where you transact directly on blockchain, this has some operational issues because that requires you to operate a node, to have a wallet, to have a private key, which is, not necessarily an easy thing to do, and also opens you up to cyber risk and cyber attack. If you decide to hold your cryptocurrencies on an off-chain or via an intermediary, again, there's legal uncertainty around what your actual rights in those cryptocurrencies are, and how you'd be able to get your interest back in the event of a custodian default. And that was flagged up recently when FTX collapsed, where a lot of FTX's customers just lost their assets. And then finally, it's worth mentioning that another potential barrier to holding cryptocurrencies physically, certainly in the UK, is that the FCA requires registration under its anti-money laundering regime, and that applies to people who are offering crypto services either as a crypto exchange provider or a crypto custodian wallet provider. The registration process is quite onerous. It requires you to register under the anti-money laundering rules, even if you're already registered and authorised by the FCA. And it's quite difficult to obtain that registration. So the FCA has reported that approximately 80 to 90% of people who go through the application process actually have their applications rejected. So for all of those reasons, you can see that actually being able to take exposure to cryptocurrencies via a cash settled derivative where you never actually have to physically hold or take ownership of the underlying currency can be quite advantageous when you look at all of those challenges to physically holding. Next slide, please, Jess. So in terms of how cryptocurrency linked OTC derivatives have been documented, well, historically, it's been quite a fragmented approach because there haven't been any definitions for cryptocurrencies. And obviously, us as derivatives lawyers, we're used to having a nice little definitions booklet for each of the major asset classes, which have been designed for those asset classes and include provisions that relate to them, including pricing methodologies, appropriate fallbacks, and have given due consideration to certain events that could happen with respect to the relevant asset, and therefore what the consequences should be if one of those events were to happen, and what the impact should be on your derivatives contract. Those definitions have not historically been in existence for cryptocurrencies. So what people have tended to do is document on adapted versions of the FX definitions, the equity definitions, and in some cases the commodity definitions. Which set of definitions is used tends to be based simply on which business unit in the relevant financial institution is responsible for cryptocurrencies, and in some cases which legal team is responsible for that business. So that obviously doesn't create an ideal situation, because using FX, equity, or commodity definitions for cryptocurrency derivatives is likely going to be inadequate, not least because they don't consider cryptocurrencies as an asset, because for the basic reason of crypto or digital assets weren't in existence when those booklets were drafted, and so they don't address the esoteric nature of the asset. Just to give some examples, there won't be adequate pricing sources in any of those definitions. There won't be fallbacks. There will be no contemplation of the technology underpinning the cryptocurrencies, and therefore technological events which could occur that affect the asset and require adjustment to the contract. For example, forks and airdrops won't be considered. And so that has led to people having to do some quite bespoke drafting, which also raises other issues and challenges. For example, basis risk. If you've got people documenting on different sets of definitions with different sets of bespoke drafting, then you don't necessarily have alignment, and you don't have certainty on what your rights and obligations are when things go wrong. Some of this was highlighted recently during the FTX collapse. So even though FTX was a crypto exchange, it did list prices. And if you think about if you had a OTC derivatives contract that listed FTX as the pricing source, but hadn't thought to build in fallbacks, once FTX went down, you had no way to get a price that fed into your OTC derivative. So as a result of all of that, and to try and fix some of those issues, ISDA have consulted with their members, and at the end of last year they've now published a set of definitions for use with digital asset derivatives. Edward's going to take a closer look at those a little bit later, looking at what they cover, and actually, in some cases, more importantly, what they don't cover. Next slide, please. Okay, so just finally, just to highlight some further developments. So we've talked about the publication of the digital asset definitions, which is perhaps the most or the biggest development in the OTC crypto space. Other initiatives that ISDA are undertaking, they're looking at expanding those digital asset definitions. As Edward will talk about, they're actually quite narrow in terms of what type of transaction you can use them for. They don't currently contemplate physical settlement. For the reasons that I mentioned, there are issues with physical settlement, but there is a plan to try and address some of that in the future. The current ISDA netting opinions don't have crypto-linked derivatives as a covered product. ISDA are planning to address that in the next round of updates. So they'll either be included in netting opinions from this year or for some jurisdictions, I think, next year. So that will allow market participants who do rely on those netting opinions to have comfort that their crypto-linked derivatives will also be covered by those. And then lastly, there's a sort of broader initiative, which is probably a longer term thing, which is developing contractual standards for people who want to actually take crypto assets as collateral for their OTC derivative transactions. As you can imagine, there are various issues with that, particularly how you take security over the assets. For the reasons that I suggested earlier, it's not clear what your property rights are, for example. And sort of, again, linked to that, there are broader initiatives to reform the law to address some of this. So currently, under English law, there are two types of property right. There are types of property. There are things in action and things in possession. Crypto assets don't neatly fit within either of those categories, which leads to the question around what type of property you have and what rights you have in that property. So the UK Law Commission is currently consulting on whether a third category of personal property should be introduced in English law, and that would be a data object, which could help address some of those issues. And equally, there are other global initiatives that are in a similar vein. So with that, I'll hand over to Edward, who'll take a little bit of a closer look at the digital asset definitions.
Brilliant. Thanks a lot, Jenny, for that. And maybe move to the next slide, Jess. Thank you. So yeah, the digital asset definitions, as Jenny said, has published recently its first set of definitions for cryptocurrency and other digital asset derivatives. And yep, she's right, they are at the moment fairly limited in scope in terms of what they cover, only non-deliverable forwards and options, so cash settlement only. And the only reference assets that they contemplate are Bitcoin and Ethereum. That obviously makes sense to have a fairly limited sort of starting point, baby steps at first, and then going forward, you can start adding different transaction types, different underlying assets there. But when we come to look at them, actually, it's almost more interesting to look at the things they don't cover, which are aspects such as physical settlement, swaps, and then the possible changes that you need to the other parts of your contractual suite of documents. So both the ISDA master agreement and the early termination provisions, is there anything you need to consider there? And also looking to possible changes to the marginal collateral provisions to deal with the particular nature of trading crypto derivatives. Next slide, please, Jess. So in many respects, these definitions should be quite familiar to many of you. As Jenny mentioned earlier, people were previously using either equity definitions or FX definitions, and the digital asset definitions are to a degree a bit of a hybrid of those two. So if you're familiar with those, then you'll see a lot that that is familiar in these new definitions. Similarly, the settlement price is determined similar to you'd have with other underlyings. So you just look at the stated strike price or settlement price against the forward price or the strike price. The definitions use the term multiplier, which covers the number of units or the notional amount, or the similar concept there to get over the notion of these assets, obviously being of a sort of a digital nature. Options are automatically exercisable, and as you expect, there are provisions for corrections to the settlement price. Next slide, please. The definitions contain a settlement price source matrix, which lists the main price sources that people can use for their transactions, and sets out certain aspects to it, such as the source locations. And in fact, these are done by reference to website URLs rather than sort of Bloomberg pages or similar that's used in the past. And it's also worth noting that these definitions are written in a slightly different style. They're much more sort of a logic-based, if this, then that style to the way the provisions are drafted, which is obviously clearly looking forward to the definitions being used in smart contracts and other sorts of coding situations there. So people are looking forward to how the derivatives markets may develop and how the legal documentation may develop going forward. Next slide, please. So disruption events, some of these are quite familiar from previous definitions for previous asset types, and some of them are quite new, reflecting the underlying technology of crypto assets. And that's why in our last session we spent some time talking about the technology which underpins cryptocurrencies and digital assets, because certain features of that technology can create the possibility of a disruption event arising, and therefore the need to deal with the event and deal with the consequences of it. So the ones I've listed on this page are fairly familiar. So there are events for price source unavailability and discontinuance, and then also material change in methodology. So if the price source makes a material change to the way it calculates its prices, then that again could be the basis for a disruption event to occur. And equally, the fallbacks should be reasonably familiar to people. As you'd expect, you can have a fallback settlement price, or in fact a waterfall of fallback settlement prices. You can also have a termination event based on the unavailability of a price source, its discontinuance. And as you'd expect, the calculation agent has a role to play. And one of the potential fallbacks is the calculation to determine what the replacement price source would be if people don't want to terminate the transaction. Next slide, please. Hedging disruption, again, a familiar concept, particularly say from the equity definitions. This results in the transaction terminating if you're unable to hedge. And similarly, there's an increased cost of hedging disruption event. And then in that situation, the hedging party is entitled to serve a price adjustment notice. If you don't accept that, then you move to terminate. So that's all familiar stuff. Fork disruption is obviously a new one. And as we talked about last week, digital assets which rely on blockchain technology effectively involve that each transaction in that currency is recorded in a block, and that block gets added to the chain. And the process for carrying out that addition requires a majority of the nodes or users or participants who are holding the ledger on that sort of distributed basis. They need to agree that the block is valid and agree that it should be added to the chain. And sometimes the process, as we heard, results into competing blocks being recognized by different participants, and that can lead to the chain splitting. Now, typically, one chain will prevail and the other one will just wither because people recognize one chain as being the one that they want to continue adding to. But on occasions, there can be a sort of a definitive split, and that's one type of fork that occurs. And then there are also times when I suppose the protocol, the consensus protocol that governs the way that particular blockchain works, the participants take a different view as to how that protocol should develop or be amended, and you end up with two very distinct digital assets resulting from that split, from that fork. Good examples are that Bitcoin had a split, so it went to Bitcoin and Bitcoin Cash, and Ethereum had something similar, where it split into Ethereum and what they called Ethereum Classic, which is different ways that people thought that the blockchain should be operated. And obviously, in that situation, you need to know what's going to happen to your derivative. And so the definitions have this concept of fork disruption, where there are at least two native digital assets resulting from the fork event. And the way that the definitions play out is that you either follow the settlement price source provider if they go to determine the successor asset, and then following this, you can have a calculation agent to determine the successor asset. And if you just aren't able to identify any successor asset, then the transaction terminates. Next slide, please. And just very briefly, for completeness sake, there are also disruption events which talk about change in law, so performance illegality or hedging illegality. And as you can imagine, with the amount of sort of regulatory change that's coming down the line, it's quite possible that these events could possibly arise, and these just typically result in the transaction terminating. So next slide, please. So that was a brief run through of what the definitions say, and as I said, there's also, I think, stuff to consider around what they don't cover, and beginning to think about how you might address those aspects if you wanted to build those into your transactions now rather than wait for these developments to move down the line. So if you're looking at a physical settlement in a digital asset, these are the issues that we feel ought to be considered and catered for in your documentation. So the mechanics of a transfer, just literally how is the transfer going to be effected and carried out? What are the steps that people need to take in order to achieve that? Consequences of forks and airdrops. We talked about forks a couple of slides back. And airdrops are situations where there's almost like a bonus issue of digital asset or cryptocurrency to all holders. And again, the documentation will need to anticipate the consequences of an airdrop in terms of what actually needs to get transferred on settlement. And even the meaning of settlement would need to be properly defined and contemplated. I talked a couple of slides back about how this forks work and how the you need for each transaction to be recorded in a block that's accepted and added to the blockchain. And obviously, if you are settling physically, you want to make sure that your transaction, the block that your transaction forms part of, is in the chain that then continues in the event there is a sort of split or a fork. And typically the way that this is addressed is that you in fact say that need to be not only your block or the block with your transaction added to it, but there needs to be a number of additional blocks also added so that you know that there's no real statistical chance that your block doesn't form part of the chain that's going to be continuing going forward. But that process would need to be built into your documentation to be able to sure what's so that you're sure what's going to be happening there and that you've actually achieved settlement. Custody arrangements play a part of this. As Jenny was saying, you have a choice. Do you hold it yourself and take the operational risks holding yourself, or do you hold it through a custodian and take the risks that are attached with these digital custodians? And you would also need to be building in convertibility events, non-transferability events. So similar to those that you see, for example, with equities, what happens if you're unable at settlement to effect a transfer? How does that play out? What are your fallbacks? How do you deal with it? Next slide, please. Margin is obviously a crucial issue. As you saw from Jenny's chart, crypto values can move rapidly. Crypto trading is often done on a 24/7 basis. So you need to think about whether the usual derivatives margin cycle based on business days is appropriate, that you need to wait until the next business day and then deliver your demand for a transfer of margin and wait for it to come in. Is that realistic if you've got a big price movement over the weekend? So one solution that we've looked at and discussed with clients is using or amending the documentation to provide for non-business day and non-business hours calls and similarly have sort of short and tightened up transfer timings to allow positions to be adequately collateralized. And given that you'll be looking for transfers to happen out of business hours, one possibility is to use other digital assets such as stable coins, those which are linked to more closely linked to fiat currencies, either structurally or on a sort of asset-backed basis, to use those as eligible collateral, because those can obviously be transferred more quickly given the 24/7 nature of trading there. So that's one aspect that people can consider as a solution if they got concerns about mark-to-markets rapidly moving outside normal business and trading hours. Next slide, please. In terms of using digital assets as collateral, certain issues obviously arise. Jenny mentioned the ongoing uncertainties of what exactly, from a legal characterization point of view, what is a cryptocurrency, and that obviously raises particular issues in relation to creating security over those types of assets. So we would expect people to be using a title transfer basis for taking collateral there. And digital assets are not eligible under most uncleared margin law regimes at the moment. So obviously, if you're taking that type of asset in order to meet an exposure, then you would need to think about substituting that for something which is eligible, so you can continue in compliance with the rules. And also, digital assets are not financial collateral. So to the extent you're relying on the Financial Collateral Directive, normally for your transactions, you need to deal with the fact that you've got some non-financial collateral as part of your arrangements. Just refer you there to an ISDA paper that was put out around the same time as they published the definitions. Although it's called Navigating Bankruptcy in Digital Asset Markets, in fact, most of it is a pretty good description of the issues that arise in relation to collateral for both crypto derivative transactions and also taking digital assets themselves as collateral there. Next slide, please. Early termination is another issue that we think needs to be considered in the context of crypto derivatives. And the reason for that is similar to margin, that there's extensive volatility in crypto trading. It happens on a 24/7 basis. And therefore, the question arises whether the normal is to early termination regime, which is based on giving notices, business days needing to elapse in order for events to crystallize. Is that appropriate in the context of trading crypto derivatives? So the areas that we think need particular consideration are grace periods. Is the normal Section 501 business day based period for remedying a failure to deliver collateral? Is that appropriate, particularly if you're looking for stuff to be delivered on a non-business day, out of business hours basis? And similarly, if you were looking to close out, you'd need to factor in the provisions of Section 6A of the ISDA Master Agreement and Section 12 in order to be considering whether you want the early termination date only to arise when you've effectively served the notice, on the basis that you can only effectively serve a notice on a business day in the place of the recipient of the notice. And then equally consider the closeout definition and the date as of which you're determining the closeout amount. Would there be situations where you'd want to be able to determine the closeout amount earlier than the early termination date if you're waiting for that process to be followed through, if you've not amended it to the way that you're satisfied there? So all those things we feel need to be considered when you start trading derivatives under crypto assets and other digital assets there. Next slide, please. And then looking at some other issues there, as Jenny mentioned, these the netting opinions don't yet cover digital assets as an underlying, although there is a process underway to start having them covered there. So again, you'd need to think about whether you need to get, so for example, a top-up opinion in order to cover this. Our view is that certainly with an English entity, closeout netting should be enforceable, but where you have regimes which depend on particular sort of legislation, safe harbors, you'd need to consider those a lot more carefully to see whether those are themselves covered and applicable. So hopefully when it's a start expanding the list of transactions, that will be covered. That was all I was going to cover about the definitions. And I think we're now moving on to Dougal to talk about structured notes.
Thanks, Edward. Yeah, structured notes, next slide. Excuse me, next slide, please. Thanks. So structured notes, as I was thinking about this, I realized one of the most fundamental distinctions in some ways is between so-called traditional finance format notes in this area versus decentralized finance format notes. And a lot of the visible activity, I guess, in the market is traditional finance-based products still, but arguably there's more innovation and more interesting things starting to happen in the DeFi space. From a legal and kind of regulatory perspective, what's interesting is that it kind of brings into relief the question of what a note kind of really is in the first place, as opposed to a derivative or something else. When we look at it from the perspective as lawyers trying to figure out what regulatory and legal questions arise. This talk focuses on TradFi, and I think that going forward is still going to represent kind of a base way of looking at these things from a legal and regulatory perspective, and then you kind of have to adapt that or add another layer of considerations when the product is originated and traded in DeFi form. So I don't think the TradFi way of looking at things is going to become irrelevant anytime soon, but I think one has to start thinking about applying those concepts to a DeFi-based product. So what am I talking about here? I'm talking about structured notes in traditional format, but which are linked in some way to digital assets or give an investor exposure in some form to digital assets in the same way that a derivative can do. And currently, I would say the products in this area break down into true derivative-like products in note format that would resemble what people are used to in the retail structured product space. And then something that people refer to variously as ETCs, ETNs, or ETPs. But there is an inconsistent use of terminology in the market. So ETN, for example, is something that could be associated with what people call ETCs in this space, which I'll talk about in a moment, or ETNs could be sort of more traditional structured notes. People use mixed terminology in a mixed and matched way. As a result of that, it's actually quite hard to figure out what the volumes really are in this space, because people don't really agree on what box exactly to put things in. Things in the pure exchange traded product or ETC space do get followed quite closely because they all tend to be listed and touted and kind of available and public. And I haven't seen the latest volumes, but there's now a whopping, I think, over 169 different crypto ETPs available on various exchanges, and I mean traditional exchanges. These aren't DeFi products, which is massive and growing apparently despite the crypto winter. So what's the main distinction in these products? So the main distinctions, I would say, are the distinctions between collateralized and uncollateralized products, and the ETC label is often used for sort of collateralized products. And it's an interesting one because it used to be called exchange traded commodities, and then as the underlying for ETCs became different things like just any kind of underlying, that they started being called exchange traded certificates, but they're originally called exchange traded commodities. Maybe those are collateralized products, and then you can have uncollateralized products, which are still in theory ETCs, but where I guess the underlying exposure to the digital asset is being obtained through some sort of back-to-back swap or something like that. They're called synthetic ETCs. And then there's a distinction between open-ended and closed-end structures. And a lot of most of the products that you think of in these space actually tend to be open-ended when I'm talking about ETCs, and they're actually quite like funds. Now they can be, giving exposure to indices or baskets, and they can be more or less structured, but they tend to be, funnily enough, open-ended. But from a regulatory perspective, often the objective is to is to put them in a debt certificate category, a debt category, as opposed to a fund category. If it is a fund, because of its characteristics, then it obviously needs to be compliant with applicable fund type regulation, whether it's collective investment fund regulation in different jurisdictions, or FMD across the UK and Europe and so on. And that gets kind of tricky to comply with on a cross-border basis, and some investors just don't want that because it will create regulatory issues for them if they're investing in something called a fund. So that's something that's an issue that comes up in the structuring of the products. Next slide, please. Next slide. Thank you. So the trading venues that seem to be most common are etc. And for that, typically people are preparing a prospectus and then complying with local listing rules. And then Swiss 6 Exchange is a big exchange for these products as well. And some of those are done kind of on a local Swiss law basis under in accordance with the Swiss regime that's been tailored to make Switzerland an attractive jurisdiction for these type of products. But also quite commonly, the products are the subject of a prospectus that's been approved by a competent authority somewhere else in Europe, and then recognized by Switzerland. So they're not part of the EU, obviously, but it's kind of a fluid mutual prospectus recognition regime. There's a question as to what these things are from a prospectus regulation perspective. Basically what annex to the prospectus reg do you need to comply with in terms of the prospectus content? And is it index linked? Are they derivative securities? Or are they asset backed? Or some combination of those? And different competent authorities have taken different views on that, and they change their approach from year to year. It gets quite complicated with tracker products in particular, because they often are structured kind of like an asset-backed security, technically speaking. But they also look a lot like index-linked instruments, and they also actually tend to verge into fund territory. So they do raise kind of tricky issues with competent authorities in terms of what box you're in and how they see it and what you need to comply with. There are very few competent authorities who even will look at these things. So BaFin has been traditionally, was the foremost competent authority and kind of in the forefront of getting their head around these products and happy to approve prospectuses. The Swedish competent authority has also been a popular choice, and that both of them remain probably the most relevant ones for significant products. Next slide, please. When you have an SPV-based structure, and these are typically the so-called collateralized structures, and you can think of them a bit like an SPV-based repack program, if you like. The SPVs themselves tend to be set up in Germany or Guernsey. It's quite difficult to find a place where one can get comfortable where these things can be set up and not be intrinsically illegal. Because they look, from afar, you could look at it and go, well, isn't the SPV itself actually some sort of crypto exchange operator or involved in the activity of exchanging fiat for crypto and so on? So the issuer itself can raise questions of what it is from an AML perspective and different regulatory perspectives. But Germany and Guernsey, Jersey seem to be jurisdictions where people are comfortable enough knowing what the SPV is from a regulatory and AML perspective in terms of duties and obligations and applicable regulations. Those structures are complicated to set up. Now, they're a combination of the complexity of structured finance and securitization on the one hand, plus the overlay of issues that arise specifically in relation to digital assets that we've been covering. So in theory, they're quite complicated to set up. In practice, given that there are now 169 of these things and more of them popping up every day, I think the people who set these things up are taking kind of a copycat approach and hoping that actually they don't really need to think through all of the issues every time anew each time you set them up. But there is actually a lot to think about these things up, and it's a bit disturbing how quickly and how many of these things are popping up. Next slide. I think a few reminders so that the mere fact that the products might be traded on a venue outside the UK, as they typically are, that doesn't mean they're outside the scope of the UK retail ban. Some people seem to be more or less concerned about that, but most people would take steps to make sure that there shouldn't be leakage into the UK to avoid a perception, probably incorrect, of contravention of the ban, but people do tend to be cautious. Stepping back to the prospectus point, I mean, there's a general issue about, and this is why I'm confident that not every competent authority will approve these things at the end of the day. I mean, there's questions to whether or not you can even, frankly, describe these products clearly and simply enough in accordance with the basic principles of prospectus disclosure. There's a question of whether or not you can really capture the risks properly. There are market approaches now to these types of disclosures, so I think there's a certain level of comfort as to what's appropriate and what's sufficient. But I would say, still, from a regulator perspective, I'm not sure that there are many competent authorities who feel comfortable with approving a prospectus, primarily for these kinds of reasons. And then there are questions about, and this is where there isn't, frankly, that much of a market practice yet. If there's a significant new factor that's created an obligation to a supplement, I mean, what does that really mean in the crypto space? There's a developing market practice around that, but I would say it's still quite immature and requires thought. I mean, things like the merge, for example, would obviously be something that would trigger a supplement, but beyond massive events, I don't think there's any consensus. What we've also seen is the BaFin approval process itself, although they were at the forefront of these things, it's become actually a very lengthy process, an uncertain process, and even getting base prospectuses approved for updates, annual updates, has been increasingly complicated. And it's unclear whether that's just general issues of that kind of pipeline at BaFin or whether it's product related, but it's something that people have been seeing a lot of as an issue. And then I guess going back to TradFi, not even digital, is when, I mean, to avoid some of these issues, some people would say, well, why even do this? Why not just do a traditional note that actually gives exposure to crypto through exposure to equities, frankly, that reflects some performance of underlying crypto or exposure to crypto. So you know, obviously not a digital asset-based structure, but it's certainly the safest from a regulatory perspective and the simplest to put on the market. And some of the big players obviously have kept with that approach for the moment. So that's probably all I have to say on this topic, and I think I'm passing it over to Steve again. Over to Steve.
Yeah, thanks, Dougal. So I'm just slightly conscious of the time, so I'll try and give the more abridged version of this talk. So yes, so we're going to talk now about the prudential treatment of crypto asset exposures, particularly looking at the new Basel Committee on Banking Supervision standard, which was published on 16th of December 2022. So this was a much anticipated standard on the prudential treatment of exposures, and that's exposures whether through direct holdings of crypto assets or indirect exposures via derivatives or exchange traded notes or crypto funds or anything similar. And this standard is going to be incorporated into the consolidated Basel framework in due course. So the standard provides a lot of much needed clarity and the potential for international harmonization. Now, the implementation deadline is set at 1st of January 2025, but so far it remains to be seen how individual jurisdictions are going to integrate the standard into their supervisory approaches, and especially prior to implementation at a local level through the various legislative frameworks, such as the Capital Requirements Regulation in the EU. In terms of what the standard applies to, I mean, anyone who's familiar with crypto asset regulation will know that this area is full of different defined terms for crypto assets, and these standards are by no means the exception. And we have yet another definition of crypto assets to contend with, which I've set out on the slide there. So as you can appreciate, this is a very broad definition that aims at capturing a wide range of crypto assets, and it's quite a relatively technology neutral definition, and it's not concerned with the specific features of crypto assets. So the regulatory status of a crypto asset does not in and of itself affect its treatment from a prudential perspective. And it will cover a whole range of things, including exchange tokens like Bitcoin and Ethereum, utility tokens, security tokens, e-money tokens, and NFTs as well will also be captured. However, one notable exception to this are central bank digital currencies, although this is something that's the BCBS are looking into and will consider as and when those types of currencies become more available. So given the broad reach of the standard in this area, and as we'll see, the quite punitive treatment of crypto asset exposures, we would expect the standard to significantly influence the activities of banks and other prudentially regulated firms within the crypto asset landscape. So in particular, we would expect there'd be a push or a discouragement of trading in unbacked crypto assets and stable coins with weak or ineffective stabilization mechanisms, and more of a push towards effectively tokenized versions of traditional securities and very high quality types of stable coins. The standards also as well somewhat encourage banks to take up custodial activities, because the BCBS have made it clear that the credit market and liquidity risk requirements set out in the standard won't apply to those types of activities. Next slide, please. So the standard involves categorizing crypto assets into two main groups, so Group 1 and Group 2, where the Group 1 assets meet a set of very tough classification conditions in full, and Group 2 assets are then the residual category that don't meet all of the classification conditions in full. Group 1 assets are then subdivided into Group 1A and 1B, depending on whether they are tokenized versions of traditional assets or whether they employ some kind of stabilization mechanism as a way of minimizing fluctuations in their value. So you might think of this Group 1B category as stable coins. So in very broad terms, the Group 1 crypto assets are subject to capital requirements based on the risk weights of the underlying exposures that underpin those assets, whether in the case of a tokenized traditional asset, it will be treated as either an equity or a bond, or with respect to a stable coin, it will be treated as if it were an exposure to the underlying asset, whether that's a commodity or a fiat currency or something else. So stable coins need to meet very rigorous redemption risk tests and a supervision/regulation requirement in order to be included in Group 1. And the purpose of this is really to ensure that only stable coins issued by highly regulated and supervised entities that have robust redemption rights and governance frameworks are eligible for the more preferential capital treatment. So the flip side of that is that algorithm-based stable coins aren't going to be eligible for Group 1, and neither are those that are based around permissionless blockchains as well. Next slide, please. So Group 2 crypto assets are the ones that fail to meet the classification conditions, and this will capture essentially all unbacked crypto assets, including the household names such as Bitcoin and Ethereum, in addition to any stable coins that fail to meet the classification conditions. Group 2 is also then split into further subgroups, and a set of so-called hedging recognition criteria are applied in order to identify whether an asset falls into Group 2A or 2B. And Group 2A assets are those that meet the criteria in full, with the result that a limited degree of hedging recognition is permitted to be recognized for regulatory capital purposes. And then Group 2B crypto assets are the ones where the criteria have not been met and therefore no offset is recognized. And in very broad terms, the hedging recognition criteria require there to essentially be some kind of exchange traded derivative or exchange traded fund or note that references the crypto asset in question. There are also tests around the minimum market cap that the crypto asset must have, the trading volume, and also the number of price observations, high quality price observations that can be observed in a particular year. So in very broad terms, Group 1 crypto assets are then subject to the existing Basel framework, subject to additional capital add-ons for differences in things like liquidity between the tokenized and non-tokenized version of the product, and as well as for discretionary infrastructure add-ons. There are also some additional interpretive guidance available to banks to help apply the traditional framework to this new asset class. And really, this treatment is a reflection of the very broad regulatory principle of same risk, same regulatory treatment. So Group 2 crypto assets, on the other hand, are subject to a new conservative framework, which is what I will touch on very briefly now. So Group 2A crypto assets are subject to market risk requirements under modified versions of the simplified standardized approach, or the standardized approaches to market risk. Internal models approach is not going to be available for calculation of market risk. And what this essentially means is that a new risk class will be created for crypto assets, and all instruments that are affected by changes in the price of the particular crypto asset must be included. A net position is then calculated for each crypto asset based on the very detailed rules in the standard, and then 100% capital charge is then applied to that net position. And then, of course, the total capital requirement is then the simple sum of all these charges across all various crypto assets. Importantly, the standard provides only some hedging effects can be recognized. So, for instance, under the simplified standardized approach, only a maximum of 65% offset can be recognized. For Group 2B crypto assets, on the other hand, these will be subject to a new conservative approach that's intended to capture both credit risk and market risk in a single metric. But for reporting purposes, it's treated as part of the bank's credit risk-weighted assets. And again, no hedging is recognized for these exposures. There's also no distinction drawn between the banking book and the trading book in this context, and exposures in both are treated in exactly the same way. So under this more conservative approach, a 1,250% risk weight is applied to the bigger of the bank's aggregate long exposures and its aggregate short exposures to a particular crypto asset. So what this essentially means is that banks are required to hold risk-based capital at least equal in value to their Group 2B crypto asset exposures, which essentially means you have to hold capital sufficient to absorb a full write-off of those exposures. Now, of course, short positions may, of course, lead to unlimited losses, but for the sake of simplicity, the risk weighting applies equally to short positions, although it may be the case that supervisory add-ons in the form of Pillar 2 add-ons may be imposed where banks have material short exposures that could lead to excess losses. In terms of derivative exposures to Group 2B crypto assets, the exposure value is calculated as the replacement cost of the derivative plus the potential future exposure, and all of this multiplied by a scalar factor called the alpha factor. And the potential future exposure is calculated as 50% of the gross notional of the transaction, applied on a transaction by transaction basis. The good news, however, is that when calculating the replacement cost, netting will be allowed, provided that there are eligible and enforceable netting sets, but there's no netting allowed between different crypto assets and their derivatives. Next slide, please. Banks' Group 2 crypto assets are also subject to an exposure limit where the bank's total exposure should not generally be higher than 1% of the bank's Tier 1 capital, and it must never exceed 2% of Tier 1 capital. So to the extent that there is a breach of the 1% limit, the bank needs to apply the more conservative Group 2B capital treatment just to the excess amount. However, where the 2% limit is breached, all of the bank's Group 2 exposures will be subject to the Group 2B capital treatments, the more punitive treatment. The standard also provides descriptions of how operational risk, liquidity, the leverage ratio, and the large exposures requirements should be applied in the context of crypto asset exposures. What it doesn't do is it doesn't impose any new regulatory treatment for those regimes. So the pre-existing regime continues to apply in the usual way, subject to some additional guidance in the context of crypto assets. The standard also maintains that banks should establish policies and procedures that describe the processes used to identify and assess the risks that are unique to crypto assets or related activities, and to implement these accordingly. And there's an expectation that banks will have to inform their supervisory authorities of these policies and procedures, as well as their actual or planned crypto asset exposures or activities in a timely manner, and to demonstrate that they fully assessed the risks and the permissibility of these activities and how these risks will be mitigated. Finally, the standards provide that the bank's disclosure requirements under Pillar 3 will also be amended to include more specific crypto asset related disclosures. Now, clearly, all of these proposals are going to have quite a negative effect on banks' abilities to engage in crypto asset business. And there's already been a lot of chatter that this will push a lot of this activity away from regulated institutions to more alternative, unregulated providers. Criticisms have already been levied at these proposals as being too crude and too risk insensitive. However, it seems that these criticisms are falling very much on deaf ears, as evidenced by the chair of the BCBS making the statement on the slide there at a recent ISDA AGM. Next slide, please. Then finally, I just wanted to finish with this diagram lifted from the standard itself, which gives a good overview of the new framework at a very high level and how the different categories of a crypto asset fit into it. So that was all I want to say on the Prudential treatment. Appreciate that was a very quick canter through it given the time. But if anyone has any questions, then we'd be happy to take them now. I see there's a few have been put into the question box. I think those are on Edward's part of the presentation. If you can see that, can you see those, Edward?
So if I can just, I think there's a couple that we can probably knock off pretty quickly. So someone asked if there's a recording of the previous session on the underlying technology. We certainly intended that the sessions were recorded. I have a feeling that there may have been a problem with the recording of the last session, but we will check that. If we can send a recording, we will. If we can't send a recording, we'd be happy, obviously, to run a separate session for any particular client who's interested in the underlying technology.
Yeah, no, Jenny, that was the case, that we didn't, something went wrong, for which deeply sorry.
Okay. There's a question about for closeout netting between two European entities with an English law ISDA, would English law apply? And in which case, as you indicated, pursuant to English law, should it? I assume that means should closeout netting work? I think the question is, if the ISDA is governed by English law, then the question is, are the provisions of the of the English law governed contract enforceable under English law. What we're saying is we're comfortable that closeout netting is enforceable under English law. But the more important question is closeout netting enforceable in the event of your counterparty's insolvency? And that depends on the local insolvency law regime in your counterparty's jurisdiction of incorporation. So in the example given, if there's 2 European entities, one French, one German, if you're the French entity, you'll be wanting to know does the German insolvency regime allow enforceability of closeout netting? So I hope that answers that question. And then the other one was around physical settlement of stable coins and whether that has the similar issues around physical settlement and transfer as other cryptocurrencies.
Yes, I mean, I think there would be the same issues around physical settlement and transfer of those. Although I would never profess to be an expert on technology, the reason that we suggest that they might be usable as or useful as eligible collateral would be obviously that by their definition, by their structure, the price or the value of those stable coins should be more stable. So I'm repeating myself, I use the word stable a lot. But the price should be more assured, and therefore you want your collateral typically to have less price volatility and less risk of the price changing. Those stable coins should be transferable again on a 24/7 basis. So you would still need to have the same mechanics around transfer and settlement and knowing when settlement has occurred, but the value of those should be more reliable and dependable, and therefore, better quality asset to take as collateral than, say, Bitcoin or Ether itself.
Okay. Thanks, Edward. Those were all the questions. So unless any others pop up in the next 10 seconds, then I think we will leave it there. Obviously, feel free to drop us an email. Our contact details are on the slides, which I believe will be circulated. So, yep, thanks everyone for joining, and we'll see you on next week's session, hopefully.